More now on this morning's GDP report. The economy grew at a 2% annual rate last quarter, thanks in large part to an increase in consumer spending. Wells Fargo chief economist John Silvia joins us now from Charlotte, North Carolina. He's actually a Bloomberg best. He's one of the most accurate forecasters on GDP. And John, I was looking at your initial estimate, which was for 1.7% for the third quarter. So this report was better than what you had expected, and certainly consumer spending a bright spot. But you see something else that's more encouraging in this report, yes?
Yeah, well, we do see a couple of other elements that I think beyond the consumer. One, equipment and software spending continues to move forward, and then non-residential construction showed up as positive for the first time in almost 2 years. So it seems like there is continued underlying demand in the U.S. economy.
What about the inventory buildup? Is that just simply building up before the holiday season?
Well, that's going to be an interesting challenge going forward. Yes, it could be primarily holiday buildup. There's a question with respect to sustainability. If it's going to be built up but not replenished anywhere near that, you might see a weaker fourth quarter going forward, so something more like 1%, again, dropping back. Inventories throw you off pretty much every quarter to quarter, but the real final sales continue to be positive for the U.S. economy.
Okay. You mentioned the spending on equipment and software. That rose 12% in the third quarter, but in the second quarter, it rose 25%. And we, of course, just heard from Microsoft and some other big tech companies that businesses are spending, but consumers aren't.
Oh, I would say that in terms of this is business equipment and software spending, it's moderating relative to the 20% plus numbers we've had in 3 or 4 quarters ago. So there is a moderation going on, but it's still supplying a lot of positive momentum, Scarlet, for the overall economy.
How much longer can that last, though, John?
Well, I would suspect it's probably going to last, again, at a moderating pace, probably for the next 2 to 3 quarters. So, again, helping that economy move forward. As you mentioned earlier, the consumer appears to be gaining some momentum, adding to economic growth. We expect that the employment numbers will show, some positive private sector and total employment growth over the next 6 months. I think that'll add a little bit more to the consumer going forward.
What did this report do in terms of the debate on deflation versus inflation? I know that from reading your past reports, you're not seeing any signs of deflation coming up.
No, I think from the Fed's point of view, when they're looking at that core PCE deflator, still below 1%. For the Fed, I think the case is, yes, we don't see deflation right now, but there is a risk if we get some negative shock to the economy. Therefore, I think the Fed will go ahead with the quantitative easing and take it out as insurance against a deflationary impact.
Is the Fed going to be looking carefully at next week's report? We've got, of course, ISM both on manufacturing and services. If today's report on GDP didn't really change the balance on the QE debate, will either manufacturing or services do anything for that debate?
No, I don't think they will. I think they'll confirm to the Fed that the economy is growing, but at a very moderate pace. But it's really the price story, I think, that bothers the Fed right now. And they don't want to get into that cycle, that Ben Bernanke made a reputation on in terms of research in the Great Depression and the deflationary impact on the U.S. economy.
Okay, I know you've said also in the past that there's no shortage of liquidity out there, even before the Fed embarks on a second round of bond purchases. But there is a lack of confidence, and we see that from companies,
yes.
We see that across the board. How is more quantitative easing or the prospect of that going to change people's willingness to spend or companies' willingness to spend?
I don't think it will. I think from the Fed's point of view, it's the instrument they have. It's the instrument they're going to use. When it comes down to confidence, though, I think individuals and businesses really need to see slightly better prospects in their own personal situation before they move forward. I would suspect that as the employment numbers come out month after month, the consumers will see that the jobs are there, they are growing, they'll be more confident. I think a lot of businesses will see sustained economic growth, and as they move forward, they'll be more optimistic as well.
All right, thank you so much. We've been speaking with Wells Fargo chief economist John Silvia.